reading the profit and loss statement and not analyzing the cash flow statement is like selecting a girl on a dating app. Photos भी हैं, description भी है, but you don't know whether they're real or fake. बिल्कुल ऐसे ही कंपनीज में प्रॉफिट देखेगा, बट ये नहीं पता whether the company is really generating cash and money and in reinvesting into their business. And in today's video, we're going to find out why the profit and loss statement is not the actual profit, the actual cash that is coming into the business, and why cash flow statement covers that part up and makes the analysis a complete analysis. So hey guys, this is Gorang, and in today's video, we're going to learn to analyze the cash flow statement, and more importantly, we're going to analyze or we are going to learn why the profit and loss statement is not the correct indicator for the cash flows that a company is really earning in an year. Now the important question: why is the profit and loss statement not the correct indicator for the profit that a company is receiving in a particular year? Look, there are mainly three factors why profit and loss statement doesn't give you the actual profit of the company, and these are: first, revenue; second, depreciation; and third, provisions. And we'll start with revenues first of all. So within revenues, as I had told you, that when a company sells its products, it doesn't sell directly to the consumers, it sells to the distributors and dealers of the company. And when they sell the product to the distributors, they tell the distributors, we are selling you the product right now, and you can pay us back the money after maybe 30 days or 40 days depending upon the deal. And this money which is not recovered is still counted in the revenues. That means, suppose on 30th March I have a company and I sell my dealer a product. Suppose I am a Maggie company and I give 100 Maggies to him for 10 rupees each. So that means I need to still get 1000 rupees in exchange for that, but that dealer or distributor will repay me after 30 days. So I haven't really earned that amount, but that amount, that 1000 rupees, is being shown in the revenues, and because the revenues are being inflated, so will the profitability, right? And that's why this creates a bit of a misconception that the profit and loss statement is the actual, or the profits that a company is receiving is the actual profit. And similarly, depreciation also affects the profit, because look, suppose I invest 1000 crore rupees to buy a plant, and I'll have to show that 1000 crore rupees as 200 crore rupees for this year and the next 4 years, right? And because of that, right now I'm spending 1000 crore rupees, but in the expense it's showing only 200 crore rupees, and because of that my profits are rising. They're not the actual profit. I might be having a loss and I might have to take a loan to invest those 1000 crore rupees, but that will not be shown in my profits. Similarly, in the following years, in the next 4 years, I'm not buying any plants or any machinery, but still those 200 crore rupees would be shown in my profit and loss statement, but I'm not expending anything. So in that case, my profits are actually underrated. They are not the actual profits that a company has more profit than that. Because of that, depreciation creates an effect on the P&L statement, and similarly the provisions also have a similar effect. So what a company does is that, suppose in the following year they know that they have to pay their employees, they have to give bonuses to their employees and various employee benefits, or they know that there may be some tax problems or different type of problems that a company is facing, and because of that they have to spend some amount of money in the following year. And because of that, what they do is that they keep some amount of money saved for that later time, and that amount of money is called provisions, which goes into the expenses part. So the company is reporting an expense, but they are not actually spending that money. They haven't actually spent that money, but they're reporting it as an expense. So because of that, the profits of the company are actually reduced. And again, the same problem, that you don't know or you don't get the real cash flow that's coming into the business. And all these problems would be solved by the cash flow statement. Not only this, the cash flow statement will also segregate into various parts, like how much amount of money is being invested into the business, how much are they earning just from their core business, and how much are they paying the dividends and different financial activities, how much they have to spend on that. So in the next part of the video, we'll be studying about the cash flow statement briefly. So there's one interesting thing I want to tell you before moving into the cash flow statement is that the cash flow statement can be derived using the P&L and balance sheet, and that's just an advantage that you need not be dependent upon the company for them to provide with the cash flow statement. You yourself can go and derive it. But anyways, it's mandatory for them to provide, and it's better to use it, so why not use it? And another thing is that the cash flow statement is really hard to manipulate, and that's why it's really good for analysis. Because look, in what can happen in the profit and loss statement is that the companies can increase their revenue by selling their products directly to the distributors. So what they'll say they'll directly dump their products into the distributors and say that you can pay us at a later time whenever you want, but just keep our products so that our revenue inflates and our profits inflate. And because of that, profit and loss statement has some problems which then can be resolved by using the cash flow statement. Now, starting with the cash flow statement, so basically it's divided into three parts. This cash flow from operating activities, as the name says, जो भी पैसा धंधे में आया because of the core portfolio of the company, that will come under cash flow from operating activities. As simple as that. जो भी पैसा धंधे में आया just by using the core portfolio, that will be under cash flow from operating activities. No other income from investing in FD or income from various sources like bank deposits or mutual funds, nothing, only from the core portfolio. And that's why it's a very good indicator. If you see these cash flow from operating activities increasing, you can say that it's a positive sign. So if the profits of a company are increasing, you should go and check whether the cash flow from operating activities of the company are increasing. Then comes the cash flow from investing activities. That means a company generated some money from the operating activities, right? Now they have to deploy that, and they'll reinvest that money to generate profit in future. So for that, what they'll do, they'll invest in certain plants, machineries, all those things which we were talking about, which were manipulated by depreciation and shown as expense by using depreciation. So you'll get the exact amount how much they're really investing into the business by using this cash flow from investing activities part. And other than this, you'll also get the investing activities, the cash that they're generating from that they generate from the investing activities, which will include returns from mutual funds, bank deposits, or even they might have given loan to their distributors and all. So all this income will come under this investing activities part. Then there's a third part also, which is cash flow from financing activities. So as I had told you that companies pay dividends whenever they make surplus profit. They don't know where they can use all that cash. So instead of just uselessly using the cash or letting it lie around within the company, they distribute that cash to their shareholders, and that dividend comes under cash flow from financing parts. Now along with this, loans which are taken by the company and the interest given by the company to the banks are also included in the financing activities part. But there's one more interesting part in the financing activities, that is when a company exports. That means suppose a company exports its products to USA, and in USA the currency is dollars, whereas in India it's rupees, and this value keeps changing, and the exports happen on a contractual basis. That means that suppose the contract took place today, and when $1 is equal to 75 rupees, and in the next 3 months the value of dollar becomes 80 rupees, but I'll have to pay only 75 rupees, and because of that 5 rupees gap I make a profit. That means actually the export is going to happen after 3 months, but the contract has been taken place today itself, and I have to pay because the price which is today, that is 75 rupees, and I make a 5 rupees gain. Now that 5 rupee gain seems to be very small, but they are exporting millions of products or thousands of products, and that 5 rupee becomes a significant amount for that, for them. And that profit or the loss which they generate because of this currency changes comes under the financing activities part. Now, I guess we have broadly understood these three parts of the statement, and let's go on to creating them. So, the process is very simple. You take the P&L statement, the balance sheet, which you have already understood in the previous videos, along with the factors that we have learned today, that is revenue, depreciation, provisions, and we combine both these two and form the cash flow statement. So, starting with the cash flow from operating part, now in this, we first take the profit before tax. Remember, don't take profit after tax, you take profit before tax. And from there, we'll subtract the depreciation and amortization part, because as we had learned that depreciation and amortization are non-cash expenses. They're not actual expenses that a company is paying. The actual expenses of buying will be covered in the cash flow from investing activities. So after we subtract the depreciation and amortization, we subtract the trade receivables and trade payables after that, because these trade receivables and trade payables affect the revenue of the profit loss statement, as I had told you before. Because the company sells their product but doesn't receive the money, and similarly that's happened with the expense also. They buy some products but they haven't actually paid for those products. So trade payables are also included in this, and we have to make adjustment for both of them. Then coming to the next part, which is provisions, and similarly in that we take provisions from in contingencies and provision for employee benefits, and that is also subtracted again from the profit before tax, and that gives you the cash generated from operations, the operating activities of the company after deducting the tax. Don't forget that. So this cash from operating activities which we have generated is the actual cash that we are receiving by selling our products in this year. Now, one thing to analyze from here is that if the profits of a company are going up, so should be their cash flow from operating activities, because it's obvious. If the profits are going up, that means they're selling more products, they're generating more profit, and that's why the real cash which they generate should be going up. But if that's not happening, you need to go and check that what may be the reason. Is the company giving too much provision for employee benefits, or there's a big problem for a company in the upcoming year, and because of that they have kept a lot of provision for the contingent liability, or they're giving too much time to their dealers and distributors to repay them back. Because of that, the trade receivables and trade payables are increasing, and all these things you need to account for and come to a point that the profit and loss statement and the cash flow statement should align with each other, and there should not be any mismatch between the two. As long as they're completely matching, then it's completely fine. Now, the next part is pretty straightforward, which is cash flow from our investing activities. So how much money that company is investing into the plants and machinery, or how much money the company is investing into the mutual funds and gaining a return from them, and how much money the company is investing into its subsidiaries, or maybe generating from the bank deposits, and all these small stuff will be covered under investing activities. And then the last statement, which is cash flow from financing activities, which has, as I had told you, that includes dividends paid by the company to their shareholders, or the interest that the company pays because of its loans. In this case, it's bank overdrafts, so they have to pay bank some interest to the bank on these overdrafts, and all this sums up and makes the net cash flow that a company really generates at the end of the year. So this cash flow, this net cash flow, can be positive, negative, that's not much of a concern. But what you have to do is actually analyze the three parts of this individually. That means cash flow from operating activities, you should see that these are including, not the net cash. Net cash, because these operating activities will be invested into the investing activities part. That means the company will take that operating activities extra money and put them back, redeploy them to expand its business even more. And that is the sign of a good business. Taking out money from the operating activities part and putting them again into the capex, into the capital expenditure part, that is what makes a good business. And one interesting thing over here is that when you subtract this cash flow from operating activities by by the investments in plants and machinery, you'll get something which is called free cash flow. And this is one of the most important part from the entire analysis. This free cash flow that a company generates, simple exercise, you have to subtract the capex from the operating activities, and you'll get this free cash flow, and it will tell you the real auqat of that company. If the company can continuously generate free cash flow over the years, it's a sign of a really good company. And you need to analyze this thing. So why, according to me, is this free cash flow so important? Because look, in simple terms, simple business layman terms, is that what do we expect from a business? A business should sell its product, it should get some money back, it should redeploy that money to expand its business, and that total amount, the money that it has generated and the money that it has again invested into the business, after that there should be some positive value which we are taking home, that the company is taking home. That simple thing is called free cash flow. And that's why we have till now learned so many complex things: profit and loss statement, balance sheet, cash flow statement, and whatnot. But this simple term, free cash flow statement, really gives you the real business that we are looking for. The small thing in a business that we are looking for is given by the cash flow statement, and that is what you have to look in the end of the analysis. A positive free cash flow statement over the years is a sign of an excellent company. So with this, we are done with the financial statements part, but this is not the end of the analysis. There are still some different type of analysis left, like ratio analysis, which makes your job really easy, and different type of business things that we'll be learning along on the journey. So why I say we will be learning along is because, look, I'm not a professional or anything. I just learn some things and impart that knowledge to you guys using this medium. And you can also do the same by learning and typing in the comment section below and letting me know. We can have a healthy discussion over that. So, but the end goal is that you get something out of this video and you become a better version of yourself. Anyways, we'll meet in the next video. Until then, be happy, keep investing, and bye bye.